So, we'll be starting at 9.
Yes, sir. We'll be starting at now.
Good morning, all. Whether am I audible?
Yes, sir, we can hear you.
Okay. I was trying to share a screen, a PPT PowerPoint. Whether is it properly shared?
Yes, sir, that's
Yes, yes,
visible,
sir.
sir.
Okay. Whenever you are ready, we can start. Okay.
Yes. We will be starting very soon. We'll just wait till 9 o'clock.
Okay, fine. How many of us are here?
Sir, in the Zoom meeting, only 12 of us, but the people joining in live from YouTube, there are about, I think, 600 to 700.
Oh, so basically, you are all become graduate, undergraduates. Am I right?
Yes,
Shashank.
yes.
Yeah. Basically, all of you are in the same class, or how is it actually?
All of us are in third year and have financial markets and banking as a subject.
Okay. But how come there is a large audience in the YouTube? Is it open to even students other than your class?
It is all the people who have taken this subject in third year, so it is, and lots
So
of people have taken it in third
it
year.
is so massive that you told actually, the number of people, YouTube participants, like, the number
Yes,
Good
is
morning,
large.
sir. So we have 6 to 7 rooms for third years. Each
Okay,
rooms roughly have 100 students. So
right,
that
right.
way we are close to 600, 700.
Okay, madam. Okay, madam. Good morning.
Good morning, sir.
Good morning to all of you.
good morning, sir. I think we'll start.
Oh, yes, yes.
Respected, yes, respected faculty, honored guests, and fellow Zavarians joining us on Zoom and tuning in via YouTube. Good morning and a warm welcome to each and every one of you. Today marks a special occasion as we convene virtually to benefit from the profound knowledge and rich experience of our distinguished guest in the realm of banking and financial markets. Before we delve into today's session, I would like to extend my sincere gratitude to Reverend Dr. Father Joseph Pulandai, SJ, Vice Principal, to Dr. Amitava Roy, Dean of BCom Morning, Dr. Partha Pratim Ghosh, Head of Department, and all our esteemed faculty members for helping set up this event. A very warm greeting to our esteemed guest speaker, Mr. Shankara Narayanan V, General Manager at UCO Bank. Sir brings with him extensive leadership and rich hands-on experience in the banking sector, regulatory frameworks, and financial market operations. As a seasoned banking professional, his expertise spans credit management, strategic operations, and navigating the evolving landscape of contemporary financial markets. In an era characterized by dynamic market trends, digital banking transformation, and evolving economic policies, having a leader of his stature guide us is an invaluable opportunity for all of us aspiring commerce and finance professionals. Sir is also an alumnus of IIM Bangalore, which is, of course, an institution all of us would aspire to study at. Without further ado, we warmly welcome Sir and look forward to an enriching and thought provoking session. Sir, please take things on from here.
Thank you, Shashank, and a very good morning to all the respected faculties, and good morning to all of you. I will make this session interactive. Uh, when I see your faces, I will feel motivated. So wherever possible, actually, you can switch on the video. So I'm just posing a question. You are buying a flat in Calcutta at 1 crore, and thereafter there is a sudden demand, and in a year's time, the price of the flat is going up from 1 crore to 2 crores. So what is the return you have made? Let us make it interactive so that at least I will get to know that whatever I am telling is reaching you. You have invested 1 crore in a flat, and in a year's time it is becoming 2 crores. So what is the return you are making?
So the return on investment would be 100%.
Correct. Can you make it 200%? All the parameters remaining the same. The initial investment is 1 crore, and the sale price is 2 crores after 1 year. Can you make it 200%?
If you borrow the initial amount and then pay back, no. I mean, if you double the
Right.
investment and
No,
borrow
don't
for
double the
the
investment. You only 1 crore you are going to buy. The flat is going to be 1 crore, and the sale price is going to be 2 crore after 1 year. You have to make it 200%. How will you do it? Anyone?
Will the time period remain the same?
Yes, 1 year only. This is just a warm-up section, so that actually this puzzle or whatever I can relate it to various things, but then it will make you agile, and uh, it will stimulate your intellect as well.
Well, in a scenario like this, you'll have a lot of other factors that you need. For example, if you're saying you're buying a flat like that, it needs to be in a central area where the prices of the
That is all those things you
properties
do
are
not take
increasing a
into
lot.
account. Only these parameters, what I told. You invested 1 crore, be it a flat or anything for that matter. And after 1 year, it becomes 2 crores. And Shashank has correctly told that the return on investment is 100%. Given this, you can actually, vary your contribution perhaps. Can you boost the return to 200%? Shall I answer?
Yes, sir.
Suppose you borrow 50 lakhs and you are putting only 50 lakhs of your investment. For the sake of simplicity, I am not taking into account the interest rate on that borrowing. For time being, actually, make the calculation very easier. So, what is your investment? 50 lakhs, correct? And what is the sale price? 2 crores. So, sorry, what is your investment? Your investment still remain 1 crore, your sale price remain 2 crore, your contribution 50 lakhs. So what is the profit you are making? 2 crores minus 1 crore is 1 crore. And what is your investment? Your investment is 50 lakhs. And you have made your return 200%. Am I right or not?
Yes.
So what is that single term in finance that contributed to the 200% return? What is that single term in finance which we use? Can you? There's a term. We did something now, which really resulted. What we did was we put our money 50 lakhs only. 50 lakhs we borrowed from a bank. We invested 1 crore, and after 1 year we sold the flat for 2 crores, and suddenly the return became 200%. What is this phenomenon called in finance?
Leverage.
Absolutely, leverage. Here, you have taken a 1:1 leverage. You put 1 rupees and the bank contributed 1 rupee. Okay. And that leverage contributed to 200%. Along with this, I will try to, I'm making this a very loose kind of session, warm-up session, as I told you. Along with this, I will also explain certain things of business also. Now, basically what happens in business? Same thing only. You have a capital. In this case, it is 50 lakhs. 50 lakhs you borrow, and 100 lakhs, sorry, 1 crore, you invested in the business. And whatever you have produced is sold it for 2 crores. Now, how fast are you going to produce? You invested some money in certain assets like raw material, you produce something, and how fast are you producing, and how quickly are you going to sell it and bring money? That's called turnover. So in any business for that matter, the return on equity of that business, return on equity is what you have calculated as 200%. Return on equity of that business is nothing but how fast you are able to turn over your asset. Suppose you are able to, simple thing, a trading activity, you are able to buy something and sell it, and you are going to realize a cash in 3 months of time, and you are going to do it in a year 4 times. That means, so that's called the turnover. Your turnover is 4. And suppose you are going to make every time when you are going to purchase and sell, you are going to make a 10% margin.
So the slide is stuck at slide 9.
Yes, I have not shown the slide. As I told you, this is just a warm-up session.
Okay.
Okay. So basically, your turnover multiplied by the profit margin multiplied by leverage, that is actually giving you return on equity. So this is what is for every business, whether it is Reliance or whether it is the vegetable vendor sitting outside on the pavement. The concept is the same. Just I want to introduce with this idea, and let us now delve into the slide. If you can actually keep the video open, it will be encouraging for me to take the session, because otherwise it will be monotonous. Now, I'm coming to this
Sir,
slide.
sorry to interrupt, sir. So if you
Yeah.
could switch to the full screen mode. There's a funnel there, top, down, bottom, next to the minimize button.
Can you repeat what you told?
So if you can switch to full slide.
Yes, can you help me? I'm not very digitally
Yes,
savvy.
sir.
How to do that?
So bottom right corner, there is this minimize and maximize sign. Next to that is a
So
funnel.
you want me to maximize the profitability.
Yes,
Now,
yes, yes.
now is it okay?
Yes, sir. Yes.
Okay. I'm not showing this slide because there are a number of slides. Okay. It becomes very difficult to cover all the slides in this 90-minute session. So I'm just starting from slide. At random, I'll be showing the slides. Okay. Now, first slide is actually this RBI balance sheet. Okay. Now, in that RBI balance sheet, you can see actually, the biggest liability portion is the currency in circulation. That is 43 trillion. 1 trillion is 1 lakh crores. Okay. Now, assume that actually RBI is increasing this currency in supply. Let us actually start actually, from the very beginning to understand, how exactly money creation happens. So, and then let us link it to the banking. Now, assume a situation, assume that actually RBI is increasing this 43 trillion by 1 trillion. So it is making 44 trillion. Okay. So this 1 trillion, what happens now? It comes to the banking side. Okay. How? Because if the money goes to the public. Simply, what it can do is that it can increase here 1 trillion, and the money is going to the public, and the public is going to put the money into the bank. So the cash involved of the bank is going to increase by from 10 trillion to 11 trillion. So 1 trillion when it comes here, somebody has deposited, public has deposited. So the deposits also will go up by 1 trillion. This is actually bank balance sheet. Okay. So from 271, it becomes 272 trillion. And bank has to keep some amount of that in reserves. And then again, the bank can lend. So in multiples of whatever money that was created here, the money supply will increase. Okay, more into that actually a little later I will come. Just like that, this is just a kind of a briefing I want to give you initially. Now you look at the bank's balance sheet actually here. What is the capital here? 25. And what is the total liabilities? 319. What is the kind of leverage we are having here? So 319 divided by 25. Roughly around 13 times leverage. Actually, what happens when banks leverage? Earlier, I told you the ones condition. Assume that there was no leverage, your return only is how much? Return was only in the example which I cited was only 100%, and when you leverage, the return became 200%. So just when you leverage 1:1, you just took a leverage of 1:1, the profit has gone up to 200%. You see the leverage of banks. The capital of the banks is 25 trillion, whereas the total liabilities of the banking system is 319 trillion. Banks are hugely leveraged entities. This is one thing you should note. Whenever leverage is there, there is also a risk. Because when you are making profit, your return goes up proportionately. But when you are making a loss, what is going to happen? You can become bankrupt. So banks are highly risky institutions because there is a huge leverage. Now, I want to ask you a question actually. What is the normal tenor of a housing loan? Anyone can answer actually. What is the normal tenor of a housing loan? Or say bank is giving loan to construct a road project. What is the normal tenor? What is the period of that loan? I mean to say normal.
5 to 10 years.
Yes, it could be more. It could be even 20 years. Okay.
Yeah.
What is the normal, deposit tenor? Any idea? Public, basically banks, if you see actually, out of the total 220 trillion, which I showed here, 220 trillion deposit. Sorry, 270 trillion. 271 trillion, around 40% of that is checkable deposits. That is, it is in savings bank and current account. It can be withdrawn in short notice. Remaining 60% is term deposits. The normal tenor is roughly around 1 year to 2 years, not more than that, maximum 3 years. Nobody is going to keep in the bank money beyond that, very rarely. Now we are giving a loan for 15 years, 20 years. How is this possible? Is it one first thing is banks are risky because I told you there's a leverage, huge leverage. Second thing is actually that our assets and liabilities does not match. Our liabilities are short term and assets are long term. So isn't it there is a huge risk being a highly leveraged entity and maturities are not matching, cash flows are not matching, there is an asset liability mismatch, there is a huge risk. Correct. Therefore, how this risk is mitigated? This risk is mitigated in two manners. The first is actually within the system itself, within the banking system itself, this risk is mitigated. How it is mitigated? Because I think you are having Basel also, no? You are having Basel coverage also, no, in your course.
Yes, sir.
Yeah. So I'm just alluding to that also simultaneously. So how exactly this risk is mitigated? First is actually in the Basel that says about in the banks there are three kind of risk. Okay, one basic major risk is credit risk. So where is it arising from? Client loan is there, 220 trillion correct client loan is there, correct. Now all the loans are having the same kind of risk. Are all the loans having the same kind of risk? 220 trillion is a total advances in the banking balance sheet which is shown, which is actually system balance sheet. That is all the scheduled commercial banks balance sheet consolidation appears like this. Now 220 trillion is a total advances in that balance sheet. Thus all the loans, individual loans in this 220 trillion carry the same kind of risk. Suppose I am giving to Reliance, suppose I am giving to government, or suppose I am giving a normal housing loan. Suppose I am giving to MSME. Risks are not the same. Is this so? Risks are not going to be the same. Risks, therefore, actually, what we do is actually first thing is we factor that risk for every loan and risk weight the loan. When we are giving to the government, there is zero risk. When we are giving a loan to a highly rated corporate, the risk may be the asset may be risk weighted at 20%. Likewise, we risk weight all these assets. So this 220 trillion is a total assets. When we risk weight it, let us assume that the risk weight is around 60%. So 220 trillion though the bank has given, when you risk weight it at 60%, roughly it comes to around 140 trillion. On that 140 trillion, you have to maintain a capital. That's called CAR, capital adequacy ratio. Currently, if you see 140 trillion and 25 trillion is the capital, the capital adequacy ratio of the banking system is roughly around 18%. So this is actually one way risk is mitigated. Credit risk is mitigated. We see actually what is the risk of each of the loan and factor the risk and risk weight the loans, and based on that actually we provide capital as a risk mitigating. This is the first risk mitigating factor. And second risk mitigating factor is actually called the leverage. That's called the leverage ratio. That leverage ratio, what it says is actually your leverage. Here in this case, as I told you, 319 divided by 25 is roughly 13 times leverage, correct? The leverage which the banks can take, RBI has prescribed that leverage ratio, it has prescribed in a different manner. It has mentioned the leverage ratio is 4%. That means actually you can take 25 times leverage. 4 is a capital and 100 is a total. So 100 divided by 4, 25. So 25 times leverage is permitted. But the total amount of leverage is contained between these two ratios. One is capital adequacy ratio, which I already mentioned. The capital adequacy ratio is 9%. Currently, the banking system is having around 18% capital adequacy ratio. And another is actually the leverage. What is the maximum leverage the bank can take? The bank can take 25 times. Currently, 13 times is the leverage on an average with the scheduled commercial banks have taken. So these are the two ratios which to a certain extent within the system mitigate the risk. There are other ratios also bank has to maintain one CRR. CRR is nothing but whatever deposits are there, certain percentage of that. Currently, it is 3%. 3% of the client deposits. Not only client deposits, net borrowing. Net borrowing means whatever borrowing and lending that is netted and added together. That's called NDTL. On that NDTL, 4% bank has to maintain as CRR, and 18% bank has to keep in high quality liquid assets, which can be quickly converted into cash. Currently, this is around 72. So if you are actually taking 72 divided by 271, it is coming around 26%. Banks are mandated to keep a minimum SLR of 18% and a CRR of 3%. Currently, this, if you see, actually, the bank has maintained a CRR of roughly a little bit above 3%. And in this case, the SLR is around 26%. Now, there is another ratio which also within the system the banks manage. One is actually called liquidity coverage ratio. So banks estimate what is the 30 days outflow, cash outflow that can happen. And bank should have more than 30 days cash inflow happening or liquid assets coverage. Bank should be in a position to convert their liquid assets or enough coverage, excess coverage should be there as HQLA so that that can be converted into cash quickly. So whatever 30 days outflow need to be met. It should be more than that, ratio should be more than cash outflow during the 30 days divided by cash inflows should be more than 100%. And not only that, there is something called NSFR, net stable funding ratio. That is, like earlier I told, the bank is giving 20-year loan, whereas the bank's funds are short term. So basically, this NSFR says that in bank should have very stable funds over 1 year, so that actually banks can actually lend longer term. In 1 year time, the stress should be limited. That is what the NSFR, if you want to say in a very lucid manner, simple manner, that is what NSFR. So what I am trying, what the takeaway is actually banks balance sheets are prone to risk. Risk is coming from two sides. One is called maturity related risk, where there is an ALM mismatch, and another kind of risk is bank is having huge leverage. To contain this, actually within the system also there is something called Basel has prescribed certain norms, which I already mentioned you. One is actually leverage ratio, and another is NSFR, and and most important thing which I told is actually the capital adequacy ratio. So within the system, these are the kind of risk mitigation, but this is not sufficient. On a system wide, there should be a risk mitigation. That is why financial market exists. So when we come to, because banks should be in a position, what is financial market? Like how we have told, banks are actually what the banks are doing. Banks are financializing savings. Banks are actually taking whatever surplus savings are available with the savers and then actually lending it to the productive sector of the economy. But there is actually also a market where some entities are having surplus funds. For instance, actually there are entities like insurance companies, correct? These companies are getting premium, but their claims are happening only when an event is happening. So these companies are very rich as far as cash flows are concerned. So when you are actually seeing the financial markets, there are various entities, like there is a insurance companies are there is a mutual fund is there are NBFCs are there are banks are there. Therefore, this financial market here also, there is an intermediation happening, where the surplus, where those entities which may require funds. For instance, actually bank is having a challenge. Actually, banks require to borrow. they can access this financial market. So what are the various kind of products available in the financial market? The financial market is broadly divided into two. One is called the money market, where actually funds can be borrowed within a year's stay, 1 year's stay. That this market is predominantly a short-term market, up to 1 year. Beyond 1 year, the market is called the capital market. Here also there are two kinds of market. One is actually debt market, where you can borrow funds more than 1 year, and another is equity market, where actually where ownership is sold. So when you come to the money market, this is where actually banks mostly operate. Banks can borrow with another in the interbank market. Means if UCO Bank, if it wants money, it can borrow, say, from State Bank of India. State Bank of India would have fixed a counterparty limit for bank, UCO Bank. Within that amount, bank can borrow from State Bank of India, or for that matter, any other bank. So that market is the call money market. Then you had seen actually in this particular slide, banks are having high quality liquid assets as well as SLR. Banks can pledge these securities and borrow money. That is called the TREPS market, tripartite repo market. Earlier it was called CBLO, now it's called TREPS. Tripartite repo market is a market where actually I will pledge my securities with another bank and raise funds. This is managed, this settlement and all that is managed through another entity called CCAL, which is the Clearing Corporation of India. So it actually, banks actually park securities with CCAL, and State Bank of India would have part, UCO Bank would have part, Canara Bank would have part, many other entities would have part. Suppose if I want to borrow from another bank, I have to just tell CCL instructions, I will pledge the securities to the other bank, and that other bank will give me money. Not necessarily bank, even I can do it with mutual funds or any other participants in the financial market. Call money, but it's a purely interbank market. Only banks operate here. TREPS is a market where I can collateralize my SLR securities and raise funds. And third kind of market is a market repo. Now, why there's already a TREP is there and why this is there, this I will explain later if time permits. Basically, banks also trade bonds, correct? This I will just briefly mention this. Now, assume the price of the bond is going to go up, then bank will purchase the bond, and when it goes up, it sells and make profit. But when the price of the bond is going to come down, what the bank can do? Bank can borrow that security and sell it currently. And when the price actually goes down, bank can buy the security and square the position. You understood what I mean? When the price is going to go down, bank is going to sell the security. But where is the security? For that, actually, this market is used, market repo. Bank will borrow the security. That is, these securities are available in benchmark securities, which are very liquid. Unlike this here, you can have state government bond, you can have any kind of SLR bond. Here, only the benchmark marketable securities. Bank can actually short sell. For allowing short sell, bank need to borrow. And this market is precisely for that. Then commercial paper, this is where actually corporate borrows their requirement, short-term requirement, their working capital requirement. They can borrow from the bank also. That is actually a retail product. Whereas they can borrow from the market directly, corporates, rated corporates, good banks corporates that are having very good rating, high rated corporates, they can borrow directly from the market. This is called the commercial paper. This is an instrument the corporates use to borrow. Then you are having the certificate of deposits. Banks, if they want to, these TREPS and call money market, they are all short term. Mostly TREPS operate within 14 days. Though longer term TREPS can be structured, but the most liquid part is very short term. Call money market is also very short term. Mostly it's an overnight market. Market repo is also very short term. Commercial paper is, as I told you, it is for corporate. Suppose bank wants wholesale deposits from the market. not retail deposit. Retail deposits are client deposit. Bank can issue something called certificate of deposits. Normally, three months, 6 months, or 1 year deposits bank issue in order to raise money. Then banks can also raise money from large corporates, and here the interest rates are negotiable. This is called bulk deposit market or wholesale deposits. T-bills are actually short-term borrowings of the government of India through instruments called T-bills. 91, 180 days, and 3. These are all discounted instruments. Here also certificate of deposit, commercial paper, all these money market instruments here, commercial paper, certificate of deposit, all these are actually discounted instruments. That it is issued at a discount, factoring the interest rate. So this is actually the money market. So this acts as a comfort to the banks. Wherever banks are finding that their internal retail funds are not sufficient to finance their activities, they can turn to this market and raise funds. Short-term funds can be raised here. Suppose bank wants to raise, bank is financing a 20-year project, and it feels that actually it has to increase the duration of its liabilities. Public is going to deposit only, give deposits only up to maximum 3 years. So where can the bank raise large term money? Is from capital markets. Bank can issue bonds here for financing infrastructure. It's called infrastructure bonds, and that comes under the category of corporate bonds. Okay. In this market, debt market, who are the main people who are active is actually, as you know, the government requires money. The tax receipts are not sufficient to finance actually our budget. So both the state government and the central government borrow from this market, from the capital market, debt market. So debt markets comprise basically of government securities market, state development loans market, SDL market, and the corporate bond market. Corporate bond market is where corporates can borrow directly long-term funds. Similarly, banks can also borrow long-term funds from here. And these government securities and state development loans, basically the clearing happens through the CCL platform. Even trading happens through a CCL platform. It is called NDS OM. So just I am introducing these kind of concepts just for the sake of at least you will remember what exactly it is. All these are available in standard textbooks. Once you go through that, you can expand your horizons of understanding in these areas. Now I am going to come to again back to the balance sheet. So as I told you, basically in the bank balance sheet, as I told you, this is the client deposits. A certain percentage of that the bank has to keep as reserves, and that is called the CRR. And bank has to keep certain percentage. Mandated is 3% CRR and 18% SLR. The beauty of this is actually where the banks can convert money to cash. As I told you, there is a repo facility available, tripartite repo facility available. Bank can pledge these securities, and once they pledge the securities, this money increases. And this money can be used for the excess money over CRR can be used for the bank to lend. Now, often we hear banking liquidity, system liquidity. What exactly is banking liquidity? This is the banking liquidity. Whatever funds that are available over the CRR, that is called the system liquidity. Banks can increase the system liquidity by pledging the securities and drawing funds from that. When they do it in the market, it is a tripartite repo. Now, as you know, banks can create, as I told you, if the banks they want left to itself, banks can create money. What is money basically? As I told you, money broadly, this is called the base money. you see currency in circulation. This is around 43 trillion. This is the base money. And there is 9 trillion, which is nothing but actually this part. 10 trillion. This 10 trillion comprises of two components. One is cash in vault, because in branches we keep cash. And similarly with RBI also we keep balances. That's called CRR. So here in this particular balance sheet, 9 trillion is a CRR and 1 trillion is a vault cash. Banks try to actually minimize this because there is no earning here. Whereas here there is earnings. Here at least we are getting some yield on the Government of India securities. For high quality liquid asset, there is some yield there. So banks keep this as a minimum, and as and when it requires, it tries to draw funds from here by purchasing reserves from the excess SLR. So left to itself, as I told you, banks can increase money. This is the base money. The base money comes here. The currency in circulation comes here into the bank. Banks can keep a part of this as CRR. Then lend. When it lends, what happens? That lending will come as deposits here. Then it parks some amount in CRR. Then again it's lend. So basically, as you know, this is nothing but increasing one side, automatically coming to the other side, and the client deposits can increase left to itself. There are some frictional challenges where we are actually considering only one balance sheet. In a system level, banks will have to settle the payments. There is some friction. So this monetary expansion is not frictionless, but for the sake of assuming from a theoretical perspective, banks can expand money supply. But you know that actually one of the most important aspect is too much of money can create inflation. Money should be sufficient enough to sufficient enough that it does not create inflation. So what is the total productive capacity in the economy, or what is the kind of potential growth an economy can have? That is very much important. If too much of money is going to be there beyond what the economy can produce, it will create inflation. So that inflation need to be managed. So Reserve Bank of India is mandated to control inflation for price stability. So how does it manage that? It uses two tools. One is when it finds that the inflation is high and there is large amount of demand, then what it will do is it will increase repo rate. Repo rate is a rate the RBI uses to control inflation. All the interest rate in the economy, it starts from this repo rate. So currently the repo rate is around 5.25%. So RBI keeps enough liquidity in the system. Enough liquidity in the system means what? This is actually this deposits of banks. This is this particular amount. This is called the system liquidity. It ensures that the system liquidity is such that it doesn't create inflation, and also it changes the cost of this system liquidity by altering something called increasing the repo when there is huge demand in the economy, or reducing the repo if it wants to be on an accommodative stance. If actually inflation is lagging and there is no sufficient demand, and in order to create demand, what it can do, it can reduce the interest rates. So when there is a reduction in interest rates, people will start availing loans, people will embark upon production, and that production is going to again create a boost into the economy, and the GDP will start growing. So this is one of the important thing, how the RBI actually ensures that this banking system liquidity remains within the comfort of RBI. For that actually, let me just take that one. So here is a transmission. So the Monetary Policy Committee every 2 months, that is, there is a MPC meeting will be there, and it will set the repo rate, and also it will simultaneously say that what is its stance. It may say that actually, we are going to have an accommodative stance, means it will keep enough liquidity in the system. Suppose they say we are going to have a restrictive stance, then it will suck liquidity from the system. If they have a neutral stance, then it will be a balanced liquidity in the system. So it manages the liquidity. And immediately the money market, which I told you, basically it targets the call money market. That is the shortest market. So how does it do that? It does it at RBI actually when it sets the repo rate, it also sets two kind of rate. One is called the SDF rate, it's called standing deposit facility, and another is called the marginal standing facility. The standing deposit facility is a floor and marginal standing facility is a ceiling. Suppose the liquidity is sufficient and banks are flooded with liquidity, then banks can deposit the money with the Reserve Bank of India at this floor rate, and that floor rate is currently 5%. And just in case banks are needing liquidity, they can go to the MSF window of RBI and dip into their SLR investments, which I told you earlier. Flood the SLR investments with RBI and take money from RBI. And that rate is 5.5. But this is the last resort. Why? Because there are cheaper options available. Because banks can raise money directly from money market. Banks can raise money from the tripartite repo at much cheaper than the MSF rate. That MSF rate will be almost near the repo rate or even below, depending upon the liquidity prevailing in the system. So MSF rates are costly. So therefore, banks mostly try to cover their requirements through the money market. And where it feels that the money market is very tight. Suppose the money market is very tight and the tripartite repo or the call money rate, suppose it is going to go beyond the MSF ceiling, then what the bank can do? The bank can borrow money from here and lend it in the tripartite repo. That the tripartite repo will come down. That is why it's called the ceiling. This particular window, MSF window, ensures that actually the money market rate is not going to breach or beyond this ceiling. The tripartite repo is not going to breach the ceiling, nor the call money rate is going to breach the ceiling. Similarly, the rates will not breach this ceiling also. Why? Because any amount of liquidity banks can deposit at 5% with the Reserve Bank of India. Suppose assume that actually the call rate goes below this, then bank will not definitely put money here. Bank can borrow from the call money market and lend it here. So therefore the call money rate will go up. So by keeping this particular corridor, it's called a liquidity adjustment facility. RBI ensures that actually the money market rates, the short-term money market rates are within the corridor. RBI can control only the short-term rates. The rates beyond 14 days, basically it's a demand and function scenario that determines the rate. Suppose there's a March quarter closing is coming and banks want to increase their profits. So they will start lending, they want to expand their balance sheet. In which case, instead of relying, when this short-term reliance may alter their various ratios also. Therefore, bank may have to raise funds from the money market. So they go to the CD market, certificate of deposit to raise money. So what will happen? Demand is happening. Then the certificate of deposit rate goes up. So this influence can be there. The short-term market influence can be there. But beyond the 14 days tenor, the interest rates are mostly determined by demand and supply, though this market also influences it. Short-term market also influences it. As long the longer the tenor, it becomes more a function of demand and supply. For instance, actually currently the repo rate is 5.25%, whereas the government of India is borrowing at 6.7 to 6.8% 10-year, because that's a 10-year money. Whereas this is a short-term money. So interest rate depends upon the tenor, and the longer the tenor, mostly it becomes a demand and supply. So I'm just going to summarize, and thereafter actually we will have some question answer sessions. So just I'm telling you the takeaway. Basically, we started with leverage. We told that actually that if leverage was not there, what is going to happen? Whatever money is going to get created by the RBI, that only can be used for economic activity. Therefore, growth will be very limited. That's one of the most primitive kind of financialization. Assume a chit fund, it happens like that. People pool, suppose 10 people together, they pool their savings and lend it to members. But the available savings is only to the extent of whatever savings the 10 persons are having. So that is the most rudimentary kind of finance. Then comes leverage. And leverage, what will happen? Leverage, it ensures that actually returns go up. But at the same time, leverage is having a risk also. So in order that the economy leverages the savings of the entities of the public, banks were created. Banks, they could leverage the savings through the money multiplier process. But leverage is having a risk. Therefore, actually, sufficient mitigation has to be there. One of the mitigation is actually having adequate capital, commensurate with the risk the bank is having. So the advances is where the credit risk is there. So the advances are risk weighted, and according to the risk weighted, a proportion of that risk weighted and a proportion of that is maintained as capital. And the minimum capital that is stipulated for Indian banks is 9%. There is actually, Basel is a very long subject. Actually, there is tier 1, tier 2, and again various stipulations of how much should be the common equity portion, how much maximum, how much can be raised through bonds for alternate tier 1. All those things are there. That, of course, it will take a longer time to explain. But the basic concept is actually whatever loss bearing capacity, unexpected loss bearing capacity the bank should have, and that is calculated by based on risk weighting the assets or the credits which the bank has given.
Yeah.
And another important aspect is actually various kind of ratios where there is a specification. Liquidity coverage ratio, bank should have enough liquid funds to take care of its 30 days funding needs. And another is actually net stable funding ratio, where banks should ensure that it is having stable funds. That means funds beyond 1 year to finance all obligations beyond 1 year. That's called NSFR. All these ratios should be more than 100%. So we currently actually banks LCR is around 120%, NSFR is also 120 to 130%. And CAR, as I told you, capital adequacy ratio, it is around 18% currently for the Indian banks, and the leverage ratio varies between 11 to 13%. 11 leverage, whatever the bank is taking, around 11 to 13 times their capital, whereas up to 25 times it is permitted as per the leverage ratio. Now, this is the internal kind of mitigation, but then internal mitigation may not be sufficient because there is a risk of asset liability mismatch. And I will introduce a term called maturity transformation here. Basically, what banks are doing is banks are using short term to finance long term assets in the economy. So it is basically what it is doing in the economy. It is actually transforming short term maturity into long term. That term is called maturity transformation. Please remember this term. So since banks are doing maturity transformation and banks are subject to risk, there should be a system backup, and that system backup comes from here, which is the money market. short-term borrowings are from this market. The first kind of uncollateralized short-term borrowing is a call money market, where it's an interbank market where banks can borrow between themselves. Bank can lend to another bank. Bank can borrow from another bank. This money is a call money. This is basically an overnight market. This call money market is very important because, as I told you, Reserve Bank of India ensures that actually that the effective repo rate hovers around the call money rate. When it is following, as I told you, there's a corridor, SDF and MSF. It ensures that the liquidity is in, suppose assume that it wants to follow a very liberal monetary policy. It will ensure that lot of liquidity prevails in the system. In such a manner, the rate goes towards the SDF rate. The call money rate goes near the SDF rate. Suppose it feels that the monetary policy should be restrictive. It sucks the liquidity in such a manner that the call money market goes towards the MSF rate. That is called the liquidity adjustment facility. It will ensure that the call money, interbank call money market, which the banks actually borrow and lend money. At the rate of interest rate, the bank borrow and lend money. That rate hovers according to what the RBI wants within that corridor. When the RBI wants that actually the rate should be lower, it should be accommodative, then banks RBI ensures sufficient liquidity in the system such that this call money market goes towards the SDF rate. And when the RBI wants to make it restrictive, it can tighten the liquidity in the system such that the call money market moves towards the MSF rate. So that is how actually RBI manages the monetary policy. And beyond call money, actually, as I told you, banks do keep minimum CRR, minimum vault cash, because cash is not going, it's an idle asset. It is not giving any return. Whatever money parked with the Reserve Bank of India, there will not be any return which RBI is going to give to the bank. Any vault cash that is maintained in the branch, there is no return that is going to come from them. Therefore, banks keep minimum CRR, and as and when it requires liquidity from the system, either it can borrow from the call money market or it can use its excess SLR and raise money from the repo market, which I told you, tripartite repo. It can raise funds from this market. These funds also, it will be more or less within that corridor only. TREPS rate also should be around 5.25, depending upon situation. Suppose RBI want to follow a tight monetary policy, TREPS can move towards the MSF rate. RBI wants to keep the monetary policy accommodative, the TREPS rate will move towards SDF rate. Same like call money market. Then market repo, it's a totally different kind of instrument which is used for actually trading bonds in the market, which I already told you. When when a benchmark security short sold, you can borrow that security from the from another entity having that security through the market repo. Commercial paper is an instrument which a corporate use to borrow their short-term needs. Is again in a wholesale market product. Certificate deposit is where, as I told you, when the banks may require funds, bank may not unduly rely on these markets because these are all basically short term. And assume a situation, banks feel that the situation is going to be very tight and interest rates are going to raise in all these other markets. So bank will try to raise these certificate of deposit. Or especially they do when they feel that as interest rates are going to rise, and the liquidity is going to get tightened, they raise deposits directly from this market. 3 months, 6 months, 1 year, even 1 month can be raised, but most liquid part of this market is 3, 6, and 12 months certificate of deposit market. Banks can also raise money directly from large corporates, and that is called the bulk deposit or the wholesale deposit market. T-bills is a market where actually government borrows short-term funds, 91, 180, and 365 days is a tenor the government can raise funds here. All these markets, these are all discounted markets. That commercial paper, certificate of deposits are all, the interest rates are factored in the price itself. And on maturity, 100 rupees is paid. Okay, suppose the amount initially, whatever is required to be paid, it factors already the interest rates. Then you have the debt market, where the government, where actually if the bank wants to raise debt or long-term funds, it can access the bond market. For banks raise infrastructure bonds, or even for capital also banks can raise bonds. So that market with the banks access the corporate bond market. Similarly, corporates can also access these markets. Government of India as well as state government, they have to fulfill budget requirements, and tax is not sufficient enough, and therefore actually they raise funds from this market. There is also another reason, because these bonds, government security, they serve as benchmark. For instance, actually 10-year benchmark, currently 6.7%. When a corporate is going to raise funds, this is served as a benchmark. The corporate is going to raise funds at 1% above Government of India benchmark. So that is how exactly it is quoted. So these securities, the GSEC serves as a benchmark also. Further,
So can I interrupt you for a second? Sorry.
yeah,
Uh, this is for the audience. The feedback form has been shared. It is available in the description of the YouTube video box, YouTube description box. Please fill up the feedback form. Thank you. Sorry to interrupt you. Sir.
yes, please. So that is a debt market. Then equity market, again, actually it is a sale of ownership. Then there is another market called the derivative market. I'm not touch basing upon that. I have not touched the foreign exchange market yet, because it will take a longer time. I'll not be able to cover everything. And CCL is nothing but the clearing corporation, and NDSOM is a platform through which the bonds are traded. Now it's going to be 10. I will wait for the questions. Beyond that, before that, I'll ask you one important question, because you are sending money, correct? From one bank to another. Through UPI, you are sending money, correct? How does the money travel? Suppose your father, who is having an account in Canara Bank, and you are having an account in UCO Bank. Your father wants to send 10,000 rupees to you. How does that 10,000 reach your account with UCO Bank from your father's account in Canara Bank? Anyone? Please.
Is it through payment rails?
Correct. Payment rails, yes. But that is again only a path, correct? Money actually travels through accounts, correct? So how does it travel?
Sir, do the banks make the immediate adjustments to the accounts, and then at the end of the day, they make the net adjustment between the two banks?
How do we do that? See, ultimately, your father is having an account in Canara Bank. So 10,000 rupees Canara Bank has to give UCO Bank, correct? Ultimately. Because your father is maintaining 10,000 rupees with Canara Bank, and your account is in UCO Bank. So that 10,000 rupees, if the UCO Bank has to give it to you, then the money has to, your father has to pay Canara Bank 10,000, or your father's account should be debited in Canara Bank. And that money, Canara Bank should pay to UCO Bank, and UCO Bank should place that money in your account. This is what exactly that needs to be done, correct? Right or wrong? Right or wrong?
Yes.
Am I right or wrong? How will
Yes.
UCO Bank pay the money unless it receives 10,000 rupees? The Canara Bank has to pay UCO Bank, na, 10,000 rupees. How does it pay?
settling digital ledgers?
Digital ledger is something you're talking about, a different kind of concept actually. You know, uh, uh, that um, uh, that is not what I intend to. Which account through money get transfer? I will tell you. This is the account. Every bank will have to maintain account with Reserve Bank of India. See the Reserve Bank of India balance sheet, correct? Deposits of banks is 9 trillion, which I told you here. See, banks are maintaining 10 trillion, 1 trillion. If you remove the cash that is kept in vault, 9 trillion. 9 trillion is with the Reserve Bank of India. So this is actually entire system. Okay. So every bank will maintain account with Reserve Bank of India. And currently, actually, the total balances maintained with the banks, various banks, is this. Basically, what happens is the Reserve Bank of India will debit Canara Bank account by 10,000 rupees and credit UCO Bank account by 10,000 rupees. This is how settlement happens. Settlement happens here. You are told that digital ledger is something a broader concept actually. That is not that is actually we decentralized ledger we are talking about. That is how Bitcoin and all that operate. That's a good concept. But then basically here, how exactly it happens for time immemorial from beginning. How exactly money gets cleared is like this. Simply, all the banks are maintaining account with the Reserve Bank of India. RBI debits Canara Bank account and credit UCO Bank account 10,000 rupees and just sends a message. That message is what is called structured financial format. It is sent. It's called SFMS message. You call it by any name, whether it is UPI, whether it is NEFT, whether it is RTGS, everything happens through this mode only. UPI happens through mobile, RTGS and NEFT are also different vehicles. But ultimately, how the money is settled? Real-time gross settlement, immediately it happens. NTGS, it is done in batches. UPI, almost instantaneous it happens. So it happens based on this. So this is the most important part. This is called banking resource. Now, how does the banking resource, what can change the banking resource? This, as I told you, is the most important part. Okay. This is called the system liquidity. Whenever we say liquidity, banking system liquidity, we say this. This is what RBI can change this. RBI can infuse liquidity. RBI can suck liquidity. When RBI infuse liquidity and suck liquidity, I already told you. When the RBI wants to, RBI feels that there is demand, sufficient demand, and inflation is going up because of the demand, then that demand maybe because a lot of money is there in the system. So therefore, RBI keeps the liquidity tighter. And also RBI increases the cost of that liquidity through repo and ensures that actually the liquidity is tight enough that the call money rate hovers around the MSF rate ceiling. And another context, assume demand is low, inflation is very low, and there is sufficient excess capacity in the system, and RBI wants to increase, and there is a less confidence is there in the economy because growth is very slow, and RBI wants to spur investments. So what it will do? It will lower the repo rate, and also simultaneously have provide sufficient liquidity in this particular space. System liquidity. It's called system liquidity. Therefore, what will happen? It has already lowered the interest rate, the repo rate, and it wants to follow an accommodative policy. Means it ensures that the liquidity is sufficient in the system so that the call money rate hovers around the floor, MSF. Once RBI does this, all the segments in the money market, the tripartite repo, the CD, the commercial paper, all these get aligned with this rate with some spread. CD rates, because the tenor is more, will be at a spread over the repo rate, higher spread over the repo rate. Similarly, 3 months, 6 months CD will be costlier than 3 months CD. 1 year CD will be costly because of the tenor. There actually some influence is there on the monetary policy. Repo rate also influences these rates. Beyond that, demand and supply also will have a. RBI cannot control that. RBI can only control this part, repo and liquidity. RBI is having only two levers. One is repo and the system liquidity. These are the two levers. Once RBI uses these two levers, then the productive segment of the economy, more loans will be given or less loans will be given. Accordingly, productivity in the economy gets impacted and inflation also gets managed. So this is what the system liquidity is. Now, I'm asking you a question. What actually impacts the system liquidity? One, RBI can impact, correct? RBI can expand its balance sheet. Okay. RBI can simply expand the balance sheet and system liquidity automatically, as I told you in the first thing I told you, when RBI balance sheet increases, it has a simultaneous effect on the bank balance sheet also. And RBI is going to give increase liquidity. What happens? It comes to the banks, correct? So RBI can infuse liquidity, RBI can suck liquidity. So liquidity can be adjusted, or RBI can create liquidity, can destroy liquidity also. Any other factor that can influence liquidity? For instance, currently you would have read in the paper FCNR. Correct. Banks were raising actually funds from abroad and swapping with RBI. So when a lot of investments are going to come into India, so I assume that interest rates in India is very attractive. Stock returns are going to be very good. So a lot of foreign portfolio investors abroad, they will come and invest in India. So a lot of foreign money is going to come into India. Liquidity will go up. Exports are happening. So much of export. We are able to sell our products outside. We are receiving foreign exchange. So that comes into India. More money, new money is going to come into India. So your liquidity will go up. Because what RBI will do, RBI will purchase a foreign currency, acquire it as reserves. And when it purchases foreign currency, it increases, it buys dollars and it sells rupees. So rupee will come into the banking system. So liquidity will increase. Similarly, when outflows are going to happen, imports are going to happen, or foreign portfolio investors or foreign direct FDIs are selling their investments in India and repatriating it outside. So banking liquidity gets squeezed. So external sector is one, uh, a lever which can impact liquidity. So RBI impacts liquidity, external sector impacts liquidity. Another thing which is going to impact is actually government. Now you have to pay tax. What is going to happen? Money will be paid from the bank accounts to the government, correct? So money is from the banking system, money will go towards the government. So banking liquidity will get impacted. Similarly, government is going to spend that money by way of salary, by way of whatever infrastructure project or whatever it is. So money again will come back to the bank. So banking liquidity gets impacted by RBI because, as I told you, RBI can create liquidity, can destroy liquidity. Similarly, when inflows come from abroad, your liquidity will increase. When money flows from India to outside, your liquidity gets squeezed. When you pay tax to the government, liquidity in the banking system gets squeezed. When government spends, money come back to the banks. And last but not the least, you and me also influence liquidity. When you draw money from the bank, cash, and keep it in your almara, banking liquidity goes down. When you take that money from the almara and put it in the bank, demonetization exactly that happened. That is why banking liquidity increased. All the notes which you kept inside the almara, you just brought it out and kept it in the bank account and gave to the bank, and bank credited your account. So when the currency held by the public, when that is deposited in the bank, banking liquidity will increase. When you withdraw money, cash from the bank, and keep it with you, in which case banking liquidity. So there are only 4 factors that impact the liquidity. One is RBI, second is external sector, third is government, and fourth is public or cash. It's called leakage, banking system leakage. Cash, when you withdraw the money, we call it called currency leakage. Okay, these are the 4 things that impact liquidity. Now, if you are going to keep money in stock or mutual fund, will the liquidity in the banking system disappear? Suppose you are having, say, 10,000 rupees in your bank account. You are going to purchase a TCS share, or an IPO is coming. Forget about that. An IPO is coming, okay? And you are going to purchase that share. So whether the banking system liquidity comes down because 10,000 is withdrawn from your deposit, does it come down? Answer.
If it is in case of the IPO, the business will probably invest it in some project. Like the money is going to the business, which is now going to invest it in something. In case it is uh, say you buy a mutual fund, someone who was already owning some shares is now selling you some shares. So it depends whether that person invests it in the bank or keeps it at home or what that
Simple
person
thing
does.
is actually that buying a share or buying a mutual fund will not impact banking because everybody is the money is going to be kept in the account only. Basically, all the money is here only. Companies are also having accounts, correct? A mutual fund is also having account, bank account. So basically, actually, when you are going to switch your savings from bank deposit to any other investment product, banking liquidity is not going to change. As you correctly told some time ago, when a company is issuing a share, from your account, the money is going to the company account, that is all. So everything is remaining within the banking liquidity only, or within this. All the money. I mean, in the sense that all the money is going to remain here, not here. I mean to say, this is only where whatever is required for settlement is kept here. All the money is going to be remaining in the here. Here. So we say that actually that when public prefers equity market or mutual funds or bank deposits, term deposits, then banks, then there is huge problem because banks will be short of funds. Is it true with this logic? No, but then there is a problem. What is the problem is actually earlier you had kept the money with the bank for 1 year, and when the money goes from that to the company account is a current account, it's a short term. Therefore, the ALM changes. As I told you, the composition, because we maintain LCR, we maintain NSFR, because our fund should be stable. The stability of the funds changes. You were actually keeping that fund for 1 year with the bank or 2 year with the bank. Suddenly you withdrew that money and put it in a share market, and the money went to suppose IPO market, and the money went to a company. In which case, essentially what is happening is actually the company's account are basically current account, or even when they are investing also, ultimately again, what period actually that money is going to remain in the bank, that matters, or what is the tenor of that particular ultimate deposit, whether the company or any other productive unit. So that tenor changes. That is where the banks are hit. It is not that the money disappears. Money can disappear only when it is sucked by RBI, or only when money is going from India to the external world. When that money is, say, when NRI is going to repatriate that money outside, yes, liquidity will get squeezed. As long as the money is remaining within the system, banking system, the liquidity is not going to be impaired. And banking liquidity is one of the most important thing. And what is banking liquidity? Banking liquidity, as far as is the what you call money available for settlement is concerned. This is exactly the banking liquidity. When we talk about liquidity, when we talk liquidity is in surplus, means this is in surplus. When we say that liquidity is in deficit, means this is in deficit. And whenever liquidity, and bank can increase this liquidity by pledging securities. Bank can borrow from another bank also. It's called call money. There no securities are required. Bank can lend these securities, or what you call bank can borrow against these securities. Flood the securities here because 18% only the CRR requirement, 26% you are having here. So bank can flood the securities and money will come here. Bank can also directly do this with RBI. That's called MSF facility. And that is the ceiling. All the tripartite repo, call money, everything will be within that MSF ceiling. And banks are having huge amount of liquidity here. What are the options? Bank can lend it in the call money. Bank can themselves lend it in the tripartite repo temporarily in the money market. Or ultimately, if that is not for any reason, actually even after that money is available, bank can lend it with the RBI in the SDF. But that is the floor. Banks will always try to maximize its return by accessing the money market rather than accessing RBI tools, because RBI tool offers the least. SDF is the least interest rate. MSF is a high interest rate to both relative to money market rates. So that is how exactly the liquidity as well as RBI management of the liquidity adjustment facility is handled. I have this PPT covers various aspects. Actually, I have not covered many. You see that actually that this see this actually. You are able to see this graph. Are you able to see this?
Yes.
You see this actually. This is the MSF and this is the SDF. And mostly actually the money market rates are within this. Call money rate is within this, except there has been some sprout due to some reason. But mostly actually it is aligned within this corridor. This is called the corridor. So this is the you already MSF rate is the green, SDF is the blue, and repo rate is a red. It is within this. And these are the money market rates, corresponding money market rates. You'll find CD rates because CD rates are low tenor, so it is like this, lower. And certificate of deposit are for longer period, so interest rates are higher. Commercial paper, there's a credit risk involved. Tenor is the same, credit risk is there, so that credit risk is priced, so that is why it is higher. These are all money market rates. Now, any questions are there? I'm open for that actually.
Sir, you showed how in some events the rates can even exceed the ceiling or like in certain
Correct.
unprecedented events. Since how do banks deal with such a risk? Like, say, for example, 2 days ago, Donald Trump announced economic D-Day against Iran, and that has affected markets. So, how do banks?
So the bank can only mitigate those risks. Okay. So banks see the thing is actually that see you see temporarily only it has gone, immediately it has come back. No, why it is? Because RBI, suppose this rates is high, RBI can borrow from the MSF. In the case of MSF, when you are availing MSF, you can dip below the 18%. You are already having system is already having 26% SLR. The system for availing MSF, you can dip below SLR. That is, you can bring down your SLR to 16% also. You can dip below SLR. So that kind of liquidity is available. No, suppose for any reason actually liquidity has become tight, huge outflows are happening, and suddenly there is a lot of withdrawals, and people are repatriating. NRIs are repatriating, FPIs are selling and repatriating money. Therefore, liquidity is going to get impacted, and the rates, money market rates, are going to shoot up. Banks are having access to MSF. They will borrow from MSF. And some agile banks can borrow from MSF and then they can lend it in the market, so that the other money market rates also can they do that's called arbitrage. They can do that, and they can bring down, and that will result that actually this comes into the corridor. Interest rates comes within the corridor. And on the exchange rate front, I have not told actually. Due to any reason, actually, when exchange rates are going to fluctuate, exchange rate is also another part that influence the money market or domestic markets in a broad way. There, actually, RBI can influence it through various measures. For instance, when um, rupee is depreciating and dollar is going up, so RBI and on account of what? On account of foreigners taking their savings or taking their investments here outside. So RBI can come and sell dollars at that point of time to meet the demand, dollar demand. So therefore, actually, likewise, RBI can intervene in the market either by when dollar is going up by selling dollars, or otherwise when a lot of inflows are there. Actually, when rupee is appreciating, it can, or dollar is coming down, it can purchase dollars. So that intervention, I have not told that part, for instance, part because currently we have covered only the money market and little bit of tenets of the Basel and on basic kind of thing actually. But then that is another part totally on the foreign exchange part, and foreign exchange part also influences the domestic market. Um, so that we have not covered, but some traces are mentioned here in the PPT. When you go through, you can find out. Anything else? Anything else?
Good morning, sir. Actually, I had a question. Like
Yeah.
many large public sector banks have, like SBI and Canara Bank, have their own AMC asset management subsidiaries. So does
Okay.
UCO Bank plan to expand in that sector?
No. Let me tell you. Actually, let us not avoid bank-specific question because it's a learning session. Correct? That becomes an individual bank-specific question. Whether we are going to have an asset management company or Canara Bank is having, an SBI is having, that is totally outside the purview of the class. Correct? In whatever you have learned here, you ask any questions, I'll answer. Anything related to banking, not only here, not only related to this. Anything you want to ask, whichever you're perhaps studying or wherever you have read something, wherever I'll be in a position to answer. I'll be happy to do that. Any questions on whatever we have discussed? I'm not sure how much it has reached whatever I told, what I have briefed in this session, but then actually, uh, basically, online there are also certain constraints. I really have not seen your faces, so in the sense that actually that while talking to you, it has become monotonous. But uh, still, your any questions are there also, you can reach out to me. My mobile number is available. I'm on LinkedIn, and my email is also available with you. You can reach out to me. And if you have any questions, please go ahead.
Thank you, sir. Seems like students do not have any more questions for now.
Okay,
So
thank you so
we
much.
wind it up.
Thank you. Thanks for this opportunity.
Yes,
Uh,
sir. Thank you so much.
Really, it was really engaging, and what we can share is actually, currently I have seen a few of your students who had connected with me on LinkedIn. All are really brilliant, actually. Their profiles, in fact, actually, what to say. A few of them have completed FRM, and again, they are doing CFA, chartered accountancy. Really brilliant people. What we can offer is wisdom. They are quite intelligent and knowledgeable, and of course, whatever knowledge that has come across through our working, that we can share. I would encourage them actually, to especially uh, Reserve Bank of India monetary policy. Please hear the governor speak, as well as go through the governor statements, go through the RBI data. RBI is having a plethora of data. Go through that and be analytical uh, about things. And especially, actually, basically, while doing the literature, actually, there are a lot many questions. That will be in each chapter, actually, where you may have to creatively engage and think about those questions, how exactly, and answer those questions. Wherever you are having doubts, please discuss with your professors as well as people in the industry. That is how you should learn. And all these courses are really very good. FRM, CFA, please pursue these courses. This will be a good for your profile building, and also do a lot of internship wherever possible. Let me tell you one thing. This I will take 5 more minutes only. Recently, actually, our bank did a hackathon where there were actually, students from various engineering institutes. They have come to the bank and worked with our IT department and developed products, and bank purchased those products. And see, just imagine, actually, when they are a student itself, they have become entrepreneur, and they take the guidance of our IT resources also, and they use our system also. That's a huge amount of learning, correct? So therefore, actually, engage with the industry, because in Calcutta, actually, there are several banks, there are several financial institutions, there are several brokerage houses, there are big corporates. So please engage with them and enhance your theoretical understanding along with practical experience, and remain connected in LinkedIn and Substack. Please be members of. Those who are not members, please take membership of LinkedIn and Substack. A lot of good art. You can connect to the rest of the world. You will have an international, audience in LinkedIn and Substack. You can access even professionals in the US Fed or Bank of Tokyo, and they are ready to answer your question. Especially, people feel so motivated to touch base with students. So please use all these platforms. You have during our time that network advantage was not there, but currently you have a plethora of opportunities. Please do that, and uh, that will help you in the long run. That's all I can say. Thank you. It was so nice interacting with all of you.
Thank you for your meaningful suggestion, sir. Shashank, you can proceed with the vote of thanks.
Yes, I'll be delivering the formal vote of thanks for today's webinar. First and foremost, on behalf of St. Xavier's College and the Department of BCom Morning, I express our deepest gratitude to Mr. Shankara Narayanan V. Sir. Thank you for sharing your valuable time, practical wisdom, and profound perspectives with us today. We learned a lot about the money market, financial markets in general, and how the banking system works. Thank you to our Vice Principal, Reverend Dr. Father Joseph Kulandai, SJ, our Dean, Dr. Amitava Roy, our Head of Department, Dr. Partho Pratim Ghosh, and the constant leadership and vision of our faculty in organizing such sessions. Finally, thank you to the participants on Zoom and on YouTube. Yes, and again, thank you very much to Sir.
Thank you so much. So shall I just close?
Yes, sir.
Yes.
We can end the
Okay.
meeting now. Thank you so
Okay.
much, sir.
Thank you.
Thank you,
sir.
Shashank. We will end the meeting here. Thank you, everyone.
Sir. Thank you, ma'am.
The organizing team can end the meeting now.